There are major elections in the U.S. every 2 years, and it seems to me that every 2 years, this scares everyone from an investment perspective. Most individuals can always find a reason not to invest. But let's take a quick step back for a brief high school civics refresher. The midterm election this year had the full U.S. House of Representatives and 1/3 of the Senate up for re-election. While we all know the results of the election at this point, the red wave that was predicted just days before the election didn't quite come to fruition. In all reality, what do elections, midterms or presidential, actually mean for markets? And should investors be concerned? We would caution investors against making short-term changes to a long-term plan to try to profit or avoid losses from changes in the political winds. For context, it's helpful to think of markets as a powerful information processing machine. The combined impact of millions of investors placing billions of dollars worth of trades each day results in market prices that incorporate the aggregate expectations of those investors. This makes outguessing market prices consistently very difficult. While surprises can and do happen in elections, the surprises don't always lead to clear-cut outcomes for investors. The 2016 presidential election serves as a recent example of this. There were a variety of opinions about how the election would impact markets, but many of the articles at the time positioned that stocks would fall if Trump were elected. The day following President Trump's win, however, the S&P 500 index closed 1.1% higher. So even if an investor would have correctly predicted the election outcome, which was not apparent in the pre-election polling, there is no guarantee that they would have predicted the correct directional move, especially given the narrative at the time. But what about congressional elections? For the midterms, market strategists and news outlets offered plenty of opinions on who would win and what impact it would have on the markets. And guess what? Some of the predictions were accurate and many were not. And as we consider real data for the stock market going back to 1926, it shows that returns in months where midterm elections took place did not tend to be that different from returns in any other month. For example, this slide shows the frequency of monthly returns, expressed in 1% increments, for the S&P 500 index from January 1926 through the end of 2021. Each horizontal dash represents 1 month, and each vertical bar shows the cumulative number of months for which returns were within a given 1% range. The blue and red horizontal lines represent months during which a midterm election was held, with red meaning Republicans won or maintained majorities in both chambers of Congress, and blue representing the same for Democrats. Purple boxes indicate mixed control, where one party controls the House of Representatives and the other controls the Senate, while gray boxes represent non-election months. This graphic illustrates that election month returns were well within the typical range of returns, regardless of which party won the election. Results similarly appeared random when looking at all congressional elections, midterm and presidential, and for annual returns, both the year of the election and the year after. While it can be easy to get distracted by month-to-month or even one-year returns, what really matters for long-term investors is how their wealth grows over longer periods of time. This slide shows the hypothetical growth of wealth for an investor who put $1 in the S&P 500 index in January 1926. Again, the chart lays out party control of Congress over time. And again, both parties have had period of significant growth and significant declines during their time of majority rule. However, there is not a real pattern of stronger returns when any specific party is in control of Congress or when there is mixed control for that matter. Markets have historically continued to provide returns over the long run, irrespective of, and perhaps for those who are tired of hearing political ads, even in spite of, which party is in power at any given time. At Greenspring, we believe investing is a long-term endeavor. Trying to make investment decisions based on the outcome of elections, a war, a crypto bubble, or the direction of meme stocks is unlikely to result in reliable excess returns for investors. At best, any positive outcome based on such a strategy will likely be the result of random luck. At worst, it can lead to very costly mistakes. Accordingly, there is a strong case for investors to rely on patience and portfolio structure rather than trying to outguess the market and election result to pursue your investment returns.